Hey, it's Stuart. Today I would like to talk about the investor risk premium. And it's a term sort of borrowed from the equity risk premium, which is a term used in the Australian stock market, or really stock markets around the world. And in simple terms, the equity risk premium talks about the return that investors seek to make above the risk-free rate. And the good measure of the risk-free rate is really government 10-year bond rate, which is about 4.4% at the moment here in Australia. And in the blog, which I've got a link below, in the blog I chart what the equity risk premium looks like, or what it's been over the past number of decades. And when we look back, it's around about 5 to 6%, about 5.5% is kind of the midpoint, if you like. So if I'm going to invest in the stock market, essentially what investors are saying is I want to earn 5.5% above the risk-free rate, which is about 4.5%, so 10% from stock markets. And when you look at long-term returns, they're around about 10%, so that's worked out fine. Now, there's a few things that impact the equity risk premium, market conditions, economic conditions. You know, when the economy is really strong, investors require less reward for investing in the stock market. And then the risk on, risk off appetite. So, you know, there's times when investors are prepared to take more risk than normal, and there's times when they want less risk, and that impacts the equity risk premium. Now, I think we can use this concept to determine an investor risk premium, which is really, if I'm going to invest in any asset, you know, whether that's shares, property, anything like that, you know, what return do I want above the risk-free rate? And we've always got to benchmark the risk-free rate, because that's obviously what we can invest in without taking any risk. So if I am going to take risk, you know, I want to make sure that I'm well rewarded for it. And I think it's something that many investors don't really think enough about in terms of, you know, am I being rewarded for the risk that I'm taking? And when I talk about risk, risk means that the returns will be less than the returns that I expected when I went into the investment. So if I'm hoping to earn 10%, risk is the best way to define risk is the probability of me not achieving that 10% return. So if we want 5.5% to invest in the share market, which is very liquid, which is regulated, you know, where there's a lot of data around the share market to help us make our investment decisions, then what do we want to invest in property? You know, I would think you'd want sort of a similar return, a similar risk premium, if you like, you know, 5.5%, which means we need to earn about 10% over the long term on average to be well rewarded for that risk. Anyway, I think it's a really good concept for us as investors to think about risk before we think about returns. And I think that's really important, just to make sure, as I said, that we're being compensated adequately. So if you want to learn more, I hope you check out the blog. The link is below this video, of course. Thanks.